Hello SS2 commercial students, you're welcome to class. In today's lesson, we are going to be treating the topic profit. Last week, we treated the topic capital, and we said capital refers to the money that is used to start up a business. Capital refers to money invested in a business, and to an economist, capital refers to resources of a business that is used for further production or further creation of resources. Now, let's look at profit. Basically, profit is the benefit that accrues to a businessman as a result of engaging in business activities. So, the benefit of engaging in a business is referred to as profit. But normally, an accountant will tell you that profit is the excess of selling price over cost price. So basically, profit is the excess of your selling price over your cost price. An economist will tell you that profit refers to the reward of an entrepreneur. Basically, the economic reward that an entrepreneur gets as a result of doing a business. We have two basic types of profit. We have your gross profit and your net profit. What's gross profit? Gross profit refers to the excess of your turnover, that is um, your sales minus your returns inward, that is your net sales, the excess of turnover over the cost of goods sold, that is the cost of your sales. When you take the excess of your net sales over your cost of goods sold, what you have is gross profit, and it is basically your selling price minus your cost price of a good. Net profit is the excess of your gross profit over your expenses incurred in production. Now, in net profit, the business wants to actually know its profit position, to know if it is capable of continuing with the business. Your net profit will help you to know that. Now, after all production has been done and you've checked your cost price and your selling price, then you can less your expenses to know your net profit. Now, take trading profit and loss. We are going to calculate trading profit and loss in the next class. Now, let's look at the introduction to trading profit and loss account. Now, trading profit and loss account connotes an organization's summary of business position of the firm after all transactions engaged in the business for the year has been recorded. It's an account drawn up to show the gross profit and the net profit of a business organization for the year, and it helps to show the profit position of the business. What are the contents of the trading profit and loss account? Number one is your opening stock. Your opening stock refers to stock at the beginning of the year of the business. That is the stock that was in your shop from the previous year that you are bringing to another year. Then you have your closing stock. Your closing stock is the stock after business has actually ended for the year. Purchases refers to goods that you bought, especially raw materials, in order for further production. Sales refers to final product or finished products that you have sold. Recall that your sales is not actually your revenue. You have to take away your returns inward from your sales. So that leads me to returns inward. Returns inward are finished goods that have been distributed to the customers that are returned back to the business for various purposes, especially for spoilage and basically for spoilage. Returns outward connotes goods that were purchased by the business but have been returned back to the suppliers for various reasons, especially for probably maybe wrong accounting, the spoilage of the goods, and some other things. Carriage inward. Now, carriage inward is treated as part of your purchases, because for you to buy goods you have to bring them into the firm. So carriage inward refers to the cost of bringing your raw materials or your purchased goods into the firm for production. Now, it is treated in the trading account. Carriage outward refers to the cost that is incurred in taking finished goods to the final customers. And carriage outward is always treated as an expense. Take note. And expenses. Expenses refers to expenditures incurred in the process of running the business. Examples of your expenses include salaries and wages, electricity, insurance, um, rates, electricity, water supply, and so many other expenses that a business can actually be involved in. Uses of trading accounts. Now, what are the uses of trading profit and loss account? Number one, it helps to show the profit position of the business to know if the business is actually making a profit or a loss. Two, it helps for planning purposes. If your business is not making the actual profit that has been high marked or that has been estimated by the owners, then there's need for probably maybe reevaluation or injection of more capital into the business, or probably maybe change of management. So it helps to evaluate the business and to plan for the future. Then it provides uh, information for prospective investors of the into the business, and it also provides information for corporate organizations to actually see the profit position of a business. Finally, it helps to provide information for the tax authorities to know the profit position of the business and to know how much tax will be imposed on the business. Then it helps to compare, lastly, it helps to compare the business performance from year to year. What are the factors that could actually affect a company's profit? Number one is the selling price. If selling price is way above your cost price, obviously you know profit will be made. But if selling price is lower than cost price, then the business is making a loss. Number two is your cost of goods sold. Your cost of goods sold is your cost of sales, basically, or basically your cost price. So your cost price will also affect the profit of the business. The number of firms that are competing within the business. If you have large number of firms competing within a business, and economists will call that a competitive market, and that can actually lead to limited limited profit of the business because profit will be shared almost equally between the firms. Then number four is knowledge of the business by the seller. Now the business must be understood, well understood by the seller or the entrepreneur. That helps him to make adequate profit. A novice in the business can actually not make profit in the business. Then the last one is the forces of demand and supply. Now basically the demand for your product will determine the level of profit. So if you are producing goods and the demand for the goods is not actually coming, let's say the demand is static over a period of time and skyrockets at a particular period of time, now that dwindling proportion of sales would affect your profit. So that means that your profit, if you take it on an average, it might be low. So demand will actually affect, and also your supply. Supply will also affect. If supply is affected, then your profit will also be affected. So we've come to the end of the lesson. By next class, we are going to treat how to calculate the gross profit and the gross profit and the net profit of a business. So have a nice day and stay safe. Thank you.